key man policies, buy-sell agreements, executive bonus plans. These are things that a lot of people just, they have heard of it maybe, but don't really understand. Welcome to the Impact School of Money, where our mission is to change the way that people are educated on money. My name is Adam Davis. I'm your host. This is episode 6, where the purpose of the Impact School of Money is to learn real-world rules of money, learn how different products in the financial industry work, and then how to apply those products. Jumping into our how it works. We've covered everything from term insurance to whole life insurance to policy loans to increasing and decreasing and different premiums and multiple different concepts when it comes to life insurance. And today, what we're going to focus on is more the executive side of insurance, where that would be used, why it would be used, and for anybody that's in the financial industry, some talking points where they can talk to clients and people that they're meeting with when it comes to life insurance. So I'm going to jump over here to the board. So here's what we're going to talk about. We're going to talk about 3 concepts. One of them is called a key man life insurance policy. Okay, a key man. The next one is called a buy-sell agreement. And then the third thing that we're going to cover is something called an executive bonus plan. Okay, so the first one, a key man life policy. One of the greatest things about life insurance is that most of the time, the principle or the policy or the approach, whatever the name of it is, pretty much describes what it is. And in this case, all 3 of the ones we'll be talking about today do that exact thing. So a key man policy, what does that mean? That means that here's a business owner. Obviously, I was an artist in another life, so here's his tie. Okay, so here's a business owner, and he has been building a business for 15 years, and he's got a person in his company that he would consider to be a key man. And what does that mean? That means that if this person was to be recruited away, if this person were to die, if this person were to leave the business, that it would be a significant financial burden for the business owner. And so what a key man policy does is it is a life insurance contract, life insurance, that is purchased by the employer. So the employer would be the owner, and the insured is this key person. And so what happens is if this key person were to die suddenly, there would be a pretty significant financial burden there to hire a new person, to train them, to get them up to speed. Well, that would cost the company time. And as we all know, any company that there's a cost of time, there's going to be money that's lost involved in that scenario as well. And so the owner or the business pays the premiums for this contract, this individual passes away, then the death benefit of that life insurance policy goes back. So at death, the death benefit of this life insurance contract goes back to the business, that then they can, pull that in, and then they can use that as potential signing bonus to get that new executive or new key person, or they can take that money to make sure that the significant profits aren't lost as they train a new person or provide salaries for these new people, or whatever it is that they need to do. And so on a very basic level, the reason we're talking about this last is there are several different policies that people can use to fund a key man policy. They could just do a basic term policy, and that's going to keep the cost very low. and then that takes care of, if it's term, it would take care of a key person at the time of death. But what if this person were to quit or have incentive to go somewhere else and get recruited away? So that's why sometimes what business owners will do is they will fund a key man policy with a permanent insurance plan that is building cash value, and then that cash value could be used if the person were to leave or be fired or quit or move on to other opportunities, where then there would be cash value in that insurance contract that then they could use for potentially the same purposes. But then all along the way, they could be using that cash value for really whatever they want, because the business owner owns the cash in the plan, is the owner, can make changes, and is also the beneficiary if something were to happen to this key person. So a lot of the time, if there are multiple key people, then multiple insurance contracts are purchased on multiple. And so you think, okay, in the case of business partners could get these contracts on each other, so that if one was to pass or another one were to pass, the death benefit goes to the other partners that would be the beneficiaries most of the time, and should be for business purposes. They're not going to buy life insurance on each other, so if something happens, they can go out and buy boats and new houses and stuff like that. But here's the thing. If the company is extremely profitable and they're willing to pay more and they want to get a $50 million policy on somebody for the purposes that they were passed away, I mean, as long as they're willing to pay for it and there's a justifiable insurable need for that amount of coverage, they can go to town, right? But then the thing to think about is this key man is worth a certain amount today, and what we went over today with inflation and the rule of 72 is thinking about the future value of this key person. Okay, so that's a key man policy. Okay, the next one we're going to talk about is something called a buy-sell agreement. What is a buy-sell agreement? Well, similar to a key man policy, it describes in the title of the concept what it is. Okay, so we'll erase this really quick. And what is a buy-sell agreement? Well, a buy-sell agreement is going to be almost like a business agreement prenup, a prenuptial agreement, but getting into business with somebody, not getting married. So what happens is, let's say you have two business partners, partner number one, partner number two. This is our buy-sell agreement, and they are in conversations of starting a business. One thing to think about is if you come across a business owner, this isn't something that they all do all the time. In fact, it's probably more rare or more common that they don't have a buy-sell agreement that business partners do. Because they're excited about the business, they're excited about a product, they're excited about getting going, making money, doing whatever, that a lot of the time the legalities of getting a business properly structured from the beginning is just something that they're not thinking about. They might get their tax status set up right, but as far as, everybody hears, you think about starting a business, somebody that starts a business, and everybody wants to give their feedback on why they shouldn't start a business, or they know someone that started a business, especially with partners, that they got screwed over, et cetera, et cetera. And so what a buy-sell agreement is a predetermined formula or calculation or agreement upon which the business owners come together and they say, okay, if something were to happen to this partner, say they were to, at the time of death, what happens to the business? Okay. Second one is going to be if they became disabled and couldn't be performing their duties with the business, or if they were to decide to want to sell their share in the business. And so those bring up questions, is what would we do as a partnership if one of those three things were to happen? Well, let's say they don't set up a buy-sell agreement. Here's what would happen. There would be no negotiated price to buy out a spouse that should have a share in the business if something were to happen to their spouse that was part of this business. They become disabled, and that's a challenge. Or they want to sell the business, but if there's no predetermined agreement there, then that causes some major issues as well. And so what a buy-sell is they determine if any of these partners were to die, if any of them were to die, what is the predetermined calculation of how much they would buy out the spouse for? It would also have a predetermined calculation of if this partner were to become disabled, how they could pay off or buy out the spouse in that scenario, and then the same thing if they were to sell. So it's kind of, this one is kind of a scary one here. Well, all of them are, is because they're having to, in an early stage of their business, determine what is the future value of this business so that the person can be bought out. And so you think of from a spouse's point of view, if my wife starts a business and they run this business that becomes extremely profitable, and then she dies, wouldn't it make sense that I would have some level of interest in the value that she brought to that business being one of the partners? Well, of course. Well, if there was never a buy-sell agreement set up in the first place, then it's just going to be a big, huge court battle, which whatever share I may have had is going to get dwindled away by attorney fees and all of the different steps that this is going to have to go through to determine that. But a buy-sell agreement takes care of that. So what is a buy-sell really? So similar to the key man is it's an insurance contract that the business partners will buy on the other partners. And so it's listed out early on in the buy-sell agreement how they're going to fund the buy-sell agreement. And one of the most common ways to do that is with life insurance. So if they were to just do the approach of a term policy inside of the buy-sell, then that would take care of death only. It's not going to take care of anything if the other one becomes disabled. It's not going to take care of anything if the other one wants to sell. And so another part of the buy-sell agreement, a buy-sell agreement is not a life insurance policy, by the way. A buy-sell agreement is a legal document, and then as part of the buy-sell agreement, they would have a life insurance contract in it in case of death. But if the partnership were to use a permanent life insurance plan, say they were to use a whole life or universal life or index universal life or variable or whatever, there's going to be the two portions of the policy where there's going to be the actual insurance, the death benefit, that takes care of this one, and then you're going to have the cash value in it that's going to take care of that one. But then sometimes what people can do is they can add another piece to the insurance part, like a rider of some kind, like we talked about on episode 5. Which one are we on now? 6? So I think it was 5. Where they can have a disability rider in the insurance policy that would then take care of that one. And so getting the proper life insurance plan, because in the buy-sell agreement, they're going to have money set aside somewhere if the partner wants to sell or walk away from the business. They're going to have money set aside somewhere in the case that they become disabled, and the least expensive way to cover a disability, unless you have just a ton of money sitting somewhere, is going to be insurance. And the same thing with the life insurance portion. And so what this does is, if partner number 1 were to die, there's life insurance in place, that a portion of that life insurance goes to the spouse under that predetermined calculation of what would happen if this person were to die. that they determined a long time ago. Again, like a prenuptial agreement, but a business prenup. If the person were to become disabled, there's something in the buy-sell agreement that talks about what will we do in the case of disability, and then the same thing if they want to sell, so they don't have to go to the person's estate to try to settle it that way. Saves hundreds, potentially thousands of hours of challenges, tons in taxes. It just saves the business owner a lot of money, but then you think about it overall, the peace of mind that it's going to create for the business owner knowing that, hey, if any one of these things happened while we were still friends, while we were excited about being in business together, we made a predetermined calculation of what would happen in those cases, because there are times where business partnerships don't go very well, and if this is already in place, it protects those partners. So that, in short, obviously, if you're a tax person or an attorney or something like that, there's a lot more that goes into this than this. But this is just to understand the basic concept of why would somebody want a buy-sell agreement, and I think that makes a lot of sense of why someone would want to do it. And so going from a key man policy to this, we kind of see like an evolution of different levels of how business owners can use these. Okay, last concept of how different things work. And just by the way, key man policies, buy-sell agreements, executive bonus plans, these are things that a lot of people just, they have heard of it maybe, but don't really understand how they work, why they would need them to work, and why it's important to have. But then what this does is it makes you very conversational. If I'm meeting with a business owner, what would be a good question that I could ask? Meeting with a business owner, oh, we have a few partners, I would ask a question, and I sound intelligent. I say, so did you guys put a buy-sell agreement in place before you started the business, or did you do that a few years in? Oh, you know, we've always heard about that, but we've never done it. And so that's a huge opportunity as one of the pieces of what we do in step 2, proper protection of the 6 things that we do, to have an intelligent conversation about that. And so yes, you need to get their CPA involved. Yes, you need an attorney to draft up the documents and different product providers to make sure you're finding the very best policy for these business owners. But it makes it available to have those intelligent conversations. Okay, last, in the last couple of minutes that we have together, is something called an executive bonus plan. So similar to the other two, just the title of it alone tells us what it is. So here's a person, CEO, founder, owns the company, and let's say he has 3 key executives, key executive number 1, 2, and 3, that are extremely valuable to the company. Could he have key men policies on them? Sure, or women, I guess. Yeah, but we're talking about something different. So what an executive bonus plan is these are people that are very valuable to him from a business standpoint, strategy standpoint, that he is not interested in losing. So what a lot of companies do is they will do a 401k. Well, the challenges to a 401k is it's a non-discriminatory plan. If this one is more valuable to the business than these other 2, but they're equal partners, if it's a 401k and the business owner wants to give them a bonus into their 401k or increase the match or something to give this one an added incentive, he can't do it for just the one. In a 401k, you do it for one, you do it for all. Okay, it's a non-discriminatory plan. You can't discriminate. An executive bonus, you can discriminate, but then it provides multiple layers of benefits, because an executive bonus plan done the way that most executives do it is they do it with a cash-valued life insurance plan. Okay, and so people that, you know, and nothing against, you know, these people, but you know, the Dave Ramseys and the Susie Ormans and those that say that cash value life insurance is like the worst thing on planet Earth, is you go talk to an executive about funding an executive bonus plan that can do all the things that this can do. There's just not another plan that can do all of those things. Or you look at the buy-sell agreement we were talking about, where there's disability insurance and life insurance and cash value that's tax-free. there's just a lot of times not a lot of alternatives that give all the same benefits for the same dollar. So what an executive bonus plan is the business owner discriminating or non-discriminating and doing it equal for everyone. He will give a bonus to executive number 3. It's an executive bonus, right? So he can give a bonus to this employee or executive, and to the company, what's attached to that bonus for the company is a tax deduction. That is 100% tax deductible to the corporation. On the flip side, when the executive receives that bonus, a bonus is taxed. But instead of giving it directly to this executive, the bonus goes into a life insurance contract with cash value. And so it's a deduction to the company. Employee receives it as a taxable bonus, goes into the life insurance contract, can now grow tax-free, and come out tax-free. But then if this person were to die, it's a death benefit that goes to this executive's family. Okay, there could also be, again, a disability rider, a long-term care rider, disability, I knew how to spell, that could be attached to that so that if this person were to become disabled, a disability payout goes to the family. So you think about a 401k, or even if they were to do a Roth for this employee, when the 401k first came out, they called it the golden handcuffs because it was a benefit that could be given to an employee that would keep them with the company. But then what benefit does a 401k and a Roth provide? It provides one benefit. The benefit is they have money for retirement. Well, a properly structured cash valued plan, would that also have retirement money in it? Yes. But it also has life insurance, and it also could have disability insurance, and also have long-term care insurance, but then it could also be accessed earlier than 59 and a half, which is a restriction here. But then what that also does to the executive is it gives him the opportunity to discriminate. If this one had just an unbelievable year and the executive wanted to bonus him $20,000 into his executive bonus plan, but only $10,000 to this guy, could he do that? Yes. And so as much as, employee-minded people would look at that and say, well, that's just not fair, well, go start a business. Stop thinking about what's fair and what's not fair. Go perform. See, that's just a cop-out of them saying, well, I don't want to have to perform. I just want to be able to do the minimum and collect my paycheck. Well, if this guy outperforms you, he's going to get a bigger bonus than you. That's just how life works. And so you talk about executive bonus plans to this guy, and he loves them. But then the ones that are going to just perform anyway, well, they're going to love them too, because they know that if they perform, they could get a bigger bonus. Okay, and there's several different ways to set these up that we'll talk about on another episode where the focus is 100% on this, where similar to a 401k, the executive or the owner of the company can set up a vesting schedule for the money inside of this. So that if the person were to leave, say, after 1 year, they've set all this up and they leave after a year, they can take that life insurance contract with them and stay insured and do all that stuff. The company's not going to pay for it anymore, obviously. But then a portion of the cash value of that policy would then roll back to the company just like it does with a 401k vesting schedule. And if those last few sentences you're just like, I'm sorry, I have no idea what you just said, well then future episodes, we'll talk about vesting schedules in 401ks and how that works and why that's beneficial from a company point of view. Okay, a lot of times for the employees, is that the most, is it the nicest thing, or I'm trying to think of the right word, but that's okay. They might think that it's a negative to have a vesting schedule, where to the company it's retaining
the key employees, but then still getting a benefit if those key people are to leave before they hoped that they would. So thank you for tuning in to episode 6 today, and we look forward to seeing you next week.